Hey guys, I just want to emphasize a point really quick in this video. It goes along with what we've seen about underperformance, investor behavior, and things like that. And it has to do with timing the market. Timing the market is something that all investors try to do to an extent, okay? And timing the market means this. I want to buy low and sell high, okay? That's timing the market. When you think you can predict when the low is that you're gonna buy in and when the high is that you're gonna sell out. Because if you think about it, if everybody could do this, then everybody would sell before a market crash and they would buy back in at a market, at the very peak, at the valley of the crash, right? At the very bottom, they would buy back in. Everybody would do this. So then nobody would ever lose money and everybody would always earn more money by buying low and letting the market recover. That's timing the market. Now you can do this on an individual stock level. You can do this on a broader level, like in a fund or tracking an index. But generally speaking, timing the market is extremely difficult, okay? I'm not gonna say that it can't be done, but it is extremely different and you have very low probabilities of success, okay? One of these reasons is this: you have to get it right twice. You have to time it perfectly to get out before the crash, and you have to time it perfectly to get back in before the recovery. Lots of data has showed that is not possible on a consistent basis. You might get lucky here and there, and people do get lucky, but on a consistent basis, it just is practically impossible to get right. Again, if we could do this, everybody would do this. It would not be a strategy anymore. And so we see even with professional fund managers that have tried this, there's research about it, and they underperform the market by trying to time and make their buys and sells time it with the market. So the underlying principle here is time in the market is better than timing the market. Like we saw in the last video, put your money in and then let the investments do their thing without you meddling with them. Don't meddle with your investments. Let them be. And the longer you're in the market, the higher your probability of successful return versus you trying to mess around with it. Timing the market is extremely difficult. Now, I've done it before on small scales. I've also not done it very well in many cases. And so it's just incredibly difficult to do. The other thing that makes this hard is you get into the realm of trading when you do this. Instead of investing, you begin trading, okay? And there's a major difference. When you're investing in a company or in a fund with a thesis, you have a purpose, you understand what you're trying to aim at, and you're looking at it with a long-term perspective. You're truly invested in the thing. When you're trading, you're just looking at price, okay? You're looking at price, you're trying to sell at a high price, buy at a low price, and that's it. Very short term. You're not looking at the underlying business. You're not looking at the underlying fundamentals. There are some people that can be successful at this, but you have to understand that there are institutions that manage billions and in aggregate trillions of dollars that are all also trying to make these little moves and are also trying to time things perfectly. And so if you think that you, with your little retail brokerage account, trading on Fidelity or Vanguard or whatever, you can beat out the big institutional traders that are commanding millions and millions of dollars per trade, high frequency trading with exact quick execution, quicker than you can get on a retail platform. If you think you can outperform them, they don't get it right all the time. And they have every resource at their disposal to get it right. You're not going to be able to do it as a retail investor. So there are strategies around trading, right? You can look at fundamental analysis of investments and invest in fundamentals like, hey, strong cash flow, growth, all that stuff. Or you can look at technical analysis where you look at indicators and charts and graphs and you try and chart out momentum and pricing. There are legitimate strategies there that people use, but they are very difficult. You might hear day trading or Forex, right? Trading on the Forex, currency exchange. All of these things, they could be valid strategies, but they take a lot of work, a lot of commitment, and you still just have probability of success or failure versus surety. There's no free lunch. There's nothing that's sure. All indicators can have false copycats. There could be a breakout to the upside and you're like, oh, this stock's going to increase, and then it's a false breakout and it comes back down. So it's an imperfect science. And unless you're going to dedicate a lot of time and a lot of money and be willing to lose a lot of money to figure out those technical trading strategies, unless you're willing to do that, then you're better off looking at fundamentals and not touching it, okay? There's just a quick word about that. Timing the market versus time in the market. You want time in the market. You don't want to time the market. You're probably going to get it wrong. That's just probabilities. So hope that was helpful. I see this mistake over and over again, and so I have to address it. And people think they can outsmart it. And the probabilities that you outsmart the system and that you predict correct timing consistently is extremely, extremely low. And that's backed up by a lot of data. And so I've been there, I've tried it, I've had some success, I've had a lot of failure, and I've learned that it's probably not worth my time. And I also don't want to spend my time doing that. So set it, forget it, move on. That's my strategy. All right, that wraps up this video. We'll see you guys in the next one.
Level up with us. Hit that subscribe button.